Hello and welcome to our March Investor Update. I'm Pacome Breton, Head of Portfolio Management at JP Personal Investing. It has been a busy month, and in financial markets, we have witnessed interesting developments across different regions. In this video, I will provide an update on market performance and update you on what we see as the key highlights for February and the changes we have made to our portfolios. Equity markets were overall positive in February, with fairly large dispersion between regions. The US equity market, by far the largest in the world and in our portfolios, delivered lower returns than other regions. The S&P 500 was slightly negative for the month, losing less than 1%, a trend that was driven by technology stocks and particularly software. The Nasdaq declined by around 2% in February, and in contrast, US small caps, supported by the prospect of lower yields, rose by approximately 2% during the month. Elsewhere, performance was strong in Japan, Europe, the UK, and emerging markets, with China a notable exception. And looking more closely, emerging markets, excluding China, outperformed, finishing the month up by about 10%, led by Taiwan and South Korea. And Taiwan and South Korea are actually both performing well due to the rise of artificial intelligence. Closer to home, the UK had a strong month, particularly among large-cap stocks, with the FTSE 100 climbing by around 7%, supported by healthcare and commodity-linked sectors such as energy and materials. In fixed income, bonds performed positively, supported by encouraging inflation data on both sides of the Atlantic, which could support reductions to interest rates. In the UK, the bond market responded well to a record budget surplus of over 30 billion, which helped to ease concerns over public finances and deficit risk. Among other asset classes, the US dollar, and it's often a useful barometer, appreciated in February and partially recovering from a particularly weak January. While gold continued to shine, and despite heightened volatility, the price of gold is up by more than 20% since the start of the year. The quarterly earnings season was a key moment as well in February, highlighting the excellent health of US corporates overall. US companies reported year-on-year earning growth of around 13% for the last quarter, which was notably above the approximate 8% growth that analysts had expected before the season began. And this was accompanied by almost record profit margins for US corporates, which compare very favorably with the rest of the world. The strong earnings season and the underlying strength of US companies remains a key pillar of our confidence in US equities over the medium term. While US valuations remain elevated versus other regions, the market capacity to innovate and generate profits is second to none, and it's making US equities quite attractive for investors over medium-term horizon. Another notable theme in February was the market's perception of the new Federal Reserve Chair, Kevin Warsh, whose nomination was viewed quite positively, as investors considered how he will manage policy going forward. On one hand, being nominated by President Donald Trump, he will be expected to be supportive of lower interest rates. On the other, during his tenure on the Fed board from 2006 to 2011, he was regarded as relatively hawkish on inflation risk and favoring action to curb inflation that could include rate hikes. Our view is that he will remain broadly balanced in his approach, and it would take a meaningful reacceleration in inflation to reverse the path to lower interest rates this year. On the geopolitical front, while it was a much quieter month than January with respect to the US and Greenland, the rising risk of conflict between the US and Iran effectively materialized after the market closed for the month. The initial impact was much more on the oil market and other risky assets, and although the market reaction was somehow muted, the impact on global trade will depend on the evolution of the conflict. We made selective changes across our portfolios in February. First, we used volatility in the price in gold to increase our gold exposure across our portfolio styles. We took advantage of this heightened volatility to execute at what we view as a decently attractive entry point, and we do not plan any further increases in gold in the coming months. And secondly, toward the end of the month, we modestly reduced US equity exposures in order to tactically increase our allocation to the UK and Japan. While the US remains attractive over the long term, near-term headlines, particularly around software uncertainties related to AI and still elevated US valuations, led us to adjust our allocations modestly. We increased our allocation to the UK because of its higher exposure to the commodity sector and added exposure to Japan in response to political developments and the new Prime Minister, Sanae Takaichi, whose expected economic management follows in the footsteps of her mentor, Shinzo Abe, which we think will likely be favorable to Japanese equities. It's important to note the increased equity allocation was made with currency hedging to reduce any impact of the yen underperforming other developed market currencies. Currency hedging actually refers to the management of currency exposure or currency risk associated with owning foreign assets. So thanks for watching. As always, if you have any questions or topics you'd like us to discuss in next month's investor update, you can contact us via social media, email, or in the comments below this video. See you again next time.
As with all investing, your capital is at risk. The value of your portfolio can go down as well as up, and you may get back less than you invest. Tax rules vary by individual status and may change. Past performance and forecasts are not a reliable indicator of future performance. We do not provide investment advice in this update. Always do your own research.